So, of course, looking at the investment center, what they're responsible for and how we're going to manage that or evaluate that is the most complicated and the most important. Now, don't worry, it's not that complicated. So, from an investment center, we're looking at how we maximize the operating income, so the profit that the profit centers are using. How do we maximize, how do we use that efficiently, and how efficiently are we using our assets? So that typically leads us to two things that we're going to look at, what's called return on investment and residual income. So as we look at these, we're going to use the example of Smart Touch Learning and our tablet computer division and our e-learning division. So if you remember all the way back to financial accounting 2301, we started out with Smart Touch Learning and all we did was provide e-learning services like online trainings for companies. And then we expanded our operations to selling these tablet computers, and then we expanded them again to actually making the tablet computers. So we've got two different divisions here, and we're going to evaluate how well they are doing at not just generating income, but how well they're doing at reinvesting that income and using their assets effectively. So before we get into any of the number crunching, let's just take a minute and look at the raw data. When we look at operating income or profit for the two divisions, I want to point out a few things first. Notice the tablet computer division generates more than twice as much profit as the e-learning division. Okay, more than twice as much. They are more than 2 times as profitable. So generally, if I were to ask you, hey, which division is doing better? Most of us at first glance would say, well, the tablet computer division is. They're making more than double the amount of profit. And that would be fair. That's true. Now let's also look for a minute at their average total. But let's jump down to revenue. So even though the tablet computer division is making twice as much profit, notice that they earn less revenue than the e-learning division is. I find that very interesting. They earn less revenue and have more profit. I'm still convinced that the tablet computer division is doing better. They make less revenue and they get more profit from it, right? Whereas the e-learning division is earning $2 million more in revenue and they have less profit. Now let's look at our assets. The tablet computer division has $6.5 million in assets, and the e-learning division has $2.5 million in assets. And I'm like, well, yeah, but the tablet computer division has a lot of equipment to make the tablets, and the e-learning division certainly doesn't need all that equipment. So yeah, that makes sense. Okay. So I don't know about you, but I think just looking at this, I'm kind of on board with tablet computer division. You're doing pretty good. E-learning division, I mean, you could shape up a little bit, right? Like maybe you could do a little bit better. But let's go in and look. Let's go in and break it down and look at the data a little bit differently. So the first way we're going to look at it is what's called return on investment, or ROI. So ROI is looking at how well we are using our assets to generate profit. So the idea is you buy an asset in order to generate profit. That's the only reason we buy assets, right? You don't buy a company buys assets. They buy an asset in order to either reduce sales, or excuse me, reduce expenses or increase sales. We do not buy assets to reduce sales. We buy an asset to reduce expenses or increase sales, right? One of those two things is what our ultimate goal is. So we want our assets to turn around and generate profit for us. This is going to measure how effectively it generates profit for us. So notice our numerator is operating income. Average total assets are last year's total assets plus this year's total assets divided by 2. Okay. So let's look at our data. So our e-learning division had profit of $450,000 and 2.5 million of total assets. So they get an ROI of 0.18 or 18%. So this means for every dollar they generate in assets, they get 18 cents of profit. Okay. Now, hopefully you've got your notes and your paper and your calculator with you, so I'd encourage you to pause the video, try calculating the ROI for the tablet division right now, and then come back and restart the video and let's talk about it. Hopefully you've already calculated this. So if we look at our tablet computer division, they have $975,800 of profit and $6.5 million of assets. So their ROI is 0.15. So for every dollar they invest in assets, they only get 15 cents of profit. But I thought we said the tablet division was doing better. But they get less profit per dollar they invest in assets. Okay. Now, that doesn't mean they're doing a bad job. Certainly, they're manufacturing, they have to have more assets. Certainly, we're not saying they're doing a bad job. But the e-learning division is getting 18 cents for every dollar they invest in assets. And the tablet computer division is only getting 15 cents for every dollar they invest in assets. So we can look at ROI in a slightly different way. We can look at what's called the expanded ROI, or the expanded equation. And the expanded equation really breaks this up into two different ratios. So the first one is what we call profit margin. So profit margin is looking at, for every dollar of sales, how much do we generate in profit? So how much does every dollar of sales turn into profit? So if we look at the second ratio is what we call asset turnover. Asset turnover is looking at specifically, for every dollar we invest in assets, how much does that generate in sales? So now we can split this up and see where our companies are doing. Now, from mathematically, since profit margin has net sales revenue in the denominator and asset turnover has it in the numerator, technically these cancel out, which is how you end up with the ROI equation of just operating income over average total assets. So we're going to get the same answer. We already know that for the e-learning division it's 18%, and for the tablet division it's 15%. But what this expanded equation is going to tell us is where that's coming from. What's driving that? Is it because we're really good at profit margin, or because we're really good at asset turnover? So let's look at, again, just the calculate profit margin. So I would again ask you to pause the video, calculate the profit margin for the two divisions, and then come back and restart the video and let's talk about it. So hopefully you've done that. So let's look. For the e-learning division, our profit margin is 6%. This tells us for every dollar that we invest in, for every dollar of revenue we generate, we get 6 cents in profit. For the tablet computer division, it's 19%. So for every dollar of sales revenue, the tablet computer division gets 19 cents in profit. Okay, that's a big difference. So this is telling me that the tablet computer division is doing much, much better at controlling cost. They're doing better at controlling costs because they're turning more of their revenue into profit, like 3 times as much into profit as the e-learning division is. Now let's look at the asset turnover. So again, I'm going to ask you to pause the video, crunch the numbers, and then come back and restart it and let's talk about it. So the e-learning division, for every dollar they invest in assets, they get $3 in sales revenue. The tablet computer division only gets 81 cents. So this tells me the e-learning division is really good at only buying assets that are going to increase sales, but they're not so good at turning those sales into profit. Whereas the tablet computer division isn't getting their money back from their assets. Look, for every dollar they invest in assets, they get 81 cents in sales. They're not even getting their money back. But they're really good at taking that little bit of revenue and turning it into profit. Okay, so the e-learning division is better at choosing assets that are valuable. The tablet computer division is better at controlling cost and turning revenue into profit. When we put them together, you can now multiply the profit margin by the asset turnover to get our ROIs that we calculated earlier. So we can see that even though the e-learning division has the higher ROI, the reason they have the higher ROI is because of this asset turnover. What they need to work on is improving this profit margin. This is where they're falling short. The tablet computer division is really good at profit margin. They need to work on this profit margin. They need to work at buying assets that are going to increase sales. So another method that we can look at is what's called residual income. And residual income looks at our operating income and our total assets, and it holds it includes a factor for manager expectation. So perhaps when we're comparing the e-learning and the tablet division, we're like, well, yeah, but the tablet division has all that manufacturing equipment. We can't expect them to, for every dollar they invest in assets, to increase sales, because they've got all of this equipment, and some of it's old and some of it needs to be replaced and some of it's just real expensive. So maybe that's not fair. Okay, so our residual income is better at goal congruence because it can take into account these factors. So we're looking at a measure of what we call profitability and efficiency. So our residual income is our operating income minus what we determine to be our minimum acceptable operating income. So that minimum acceptable operating income is calculated as the average total assets multiplied by the target rate of return. And this is management's target. So management says, look, this is what I would expect you to return. Okay. So when we include this factor in it, we can adjust our expectations accordingly. So assume that each division assume the e-learning division has a 16% target rate of return. Why don't you pause the video and try calculating the residual income? So hopefully you've done that. And so you calculated that the e-learning division should generate $400,000 of profit. They're generating $450,000. So they've got excess profit. They've exceeded expectations by $50,000. Now, what if we use that same target rate of return, and you don't have to use the same target rate of return? It would be very common to say, all right, I expect the rate of return for the tablet computer division to be different, but just for the sake of argument, let's use the same target rate of return and calculate the residual income for the tablet computer division. So notice that based on their large number of assets, we would expect them to generate $1,040,000 in profit, and they're only generating just under $1 million. So in fact, they're not generating enough revenue. So the problem tends to be in those assets that they're buying. It looks like they've bought some assets that really just aren't benefiting the company. And so we need to take a look at that and see where we can do better at that. So this chart just provides us some advantages and disadvantages. Both would be used commonly and definitely used interchangeably. We want to keep our eye on both. We really like this expanded ROI so that we can really see where we're doing well and where we're not doing so well. So if I were the manager here, I would want to investigate the e-learning division. Why is their profit margin so low? What expenses are eating up all of their profit margin? And for the tablet computer division, I want to know why their asset turnover is so low, pardon me. Why are they not investing in good assets? And maybe that's something that we need to be better at doing. Now, things that we need to keep in mind. Average total assets are measured at any given point in time, okay? Also, we should not include what we call non-productive assets. So these would be assets that are held for investment purposes, not productive. Assets that we still own but are no longer using. So maybe we have some equipment that we have replaced, but we haven't sold the old equipment yet. We want to take that out of total assets for the purposes of our calculations, right? We don't want that to be held against us. But also we want to keep in the long-term goals. So it may be that maybe our tablet computer division is going through kind of a revamping stage and we're having to buy some new equipment, and this new equipment is going to be more efficient, kind of like my air conditioner that I bought. It's expense up front. It really, really ruined my ratio up front, but in the long run, it's going to provide us with more efficiency. So we need to keep that long-term focus in mind.